What's up, everybody? I'm Josh Bennett with Mr. Money Sense TV, the channel where we help you earn more, keep more, and grow more money. If you've been watching the news at all lately, I'm sure you've heard both doom and gloom and also just, the most optimistic news in the world. Some people believe the stock market's just going to keep going up and up and up and up, and we're never going to see it come down. Other people believe that doom and gloom is right around the corner and that the stock market's going to crash miserably here in the next couple months. So what's right? Are we going to have a recession in 2020? Are we going to see the stock market finally take a dip? We're going to take a look at that right now. There are a lot of different factors when it comes to determining, are we in a recession or are we about to see a recession? One of the big ones is current valuations in the market. So what do I mean by that? What are companies worth? So if you kind of think of it this way, you can sometimes buy companies at full price. You can sometimes buy them on sale, such as like a recession. It's no different than going to a department store and buying, a new iPhone. Which would you rather do? Would you rather pay for that iPhone when it's normally priced, when it's on sale, or when it's actually they're charging you more than it's actually worth? So that's what I mean by company valuations in the market. So company valuations go up and down based on kind of the psychology of the market at the time. So behavioral investing plays a big part on the stock market in general and whether a recession is going to happen. And if at this point in time, there may be people out there that are buying that iPhone or the companies in the stock market for more than they're actually worth. And that tends to happen near the top of a market or right before a recession. So what ultimately happens is people finally start realizing they're buying that iPhone for more than it's worth. And then the market goes back down to either where the iPhone's worth, or ultimately it may drop much further just because people start to panic and wonder why they were overpaying in the first place. And now they have no money and they see the stock market crashing, and then it just becomes a self-fulfilling prophecy. So that's what I mean by company valuations. So where are we right now in terms of company valuations? There's a good way to measure the valuation of the market. And this actually won a Nobel Prize for the calculation of this, and it's called the CAPE ratio. So what it means is cyclically adjusted price to earnings. So basically you have the price of the company, and then you have the earnings of the company. So those are going to vary over time. So what cyclically adjusted price to earnings does is sort of smooths that out over a 10-year period, just to kind of get an idea of historically, is this company making more money than usual, less money than usual compared to how much the company's worth. So theoretically, a company should be worth more if it's making more money. Just pretty much common sense. If it's making less money, it should be worth less. So that's what we're trying to measure with this CAPE ratio. And that's what we're going to take a look at in terms of where are we from the valuations perspective right now. So the CAPE ratio can be measured from anywhere from 0 or negative even sometimes to pretty much as high as it wants to go. So usually on average you see companies kind of in the mid-teens range. And so where are we right now? We're actually at 32, which, to put that in perspective, there's only been a few times in history where our valuations of our stock market have been higher than this. And we are also one of the highest markets in the world right now. So the times that we've only been higher than this are basically right before the crash in 1929. So what caused the Great Depression. So we're basically about the same valuation, just slightly under where we were back then. And then the only time that's been much higher was the tech bubble in the early 2000s, late 1999s. So that's where we are from a valuation perspective. We're near the highest in our country's history, and also one of the highest in the world right now. So what that tells me is that we don't necessarily have a lot of room to keep running up in the stock market. It doesn't necessarily say that the stock market is going to crash tomorrow, but it doesn't mean that there's going to be a lot of upside, in my opinion. Another factor that indicates a possible recession in 2020 is that a lot of smart money has been starting to bet against the market. So one of the most pronounced ones was Ray Dalio. So Ray Dalio runs the biggest hedge fund in the world, which is about, I think, like 160 billion. I mean, don't quote me on that, but somewhere around there. It's a huge fund. But Ray Dalio is considered one of the smartest investors in the world historically. So, I mean, he's one of the guys that the U.S. Treasury Department comes to when they need advice, just to put that in perspective. So Ray Dalio came under a little bit of scrutiny beginning or end of last year around December, November, because he actually placed a large bet against the stock market, which expires March 31st. Granted, he came out and said that it was basically just a hedge, but that being said, it was a rather large bet. And I mean, he took out about $1.5 billion on this bet that the stock market was going to crash by March 31st of this year. So that doesn't necessarily bode well for, the stock market when one of the smartest minds in investing is taking a large bet against it. That if he's wrong, essentially expires worthless. So that's something to just kind of keep in mind, that Ray Dalio, one of the smartest investors, is showing indications that he's not confident on the direction of the market, the way it's going currently. For the next indicator, we actually turn to another very popular and very renowned investor, Warren Buffett. So Warren Buffett came out and said that this ratio, he believes, is one of the single greatest ways to determine our current valuations in the market. So what that ratio is total market cap to gross national product. So translation, what the stock market is valued at as a total compared to how much our country makes in any given year. So essentially how much it's valued, kind of like a similar way of, like I was mentioning earlier, the price to earnings. So how much is a company worth versus the money it actually makes. This is more on the country level. How much is the country stock market worth compared to how much the country is producing? So Warren Buffett believes this is one of the best indicators in terms of, managing and monitoring stock market valuations. And ultimately that bill puts out a percentage that can determine whether it's accurately valued, undervalued, or overvalued. So where does this ratio put us in terms of valuation? Well, it actually puts us at significantly overvalued. So that, combined with the CAPE ratio I was mentioning earlier, doesn't bode well for current US market valuations. Again, there may be more room for us to go down than to go up just based on valuations. Ultimately, there has to be what's called a reversion in the mean, where the stock prices have to come back down to reality. There have also been a lot of other economic indicators that tend to precede recessions that have pointed towards the fact that we might be near a recession. And one of the big ones is inverted yield curve. So the inverted yield curve basically is when interest rates are higher in the short term because investors believe that there's going to be more volatility in the short term than in the long term. So the short term interest rates invert and become higher than the long term interest rates, which is sort of backwards thinking, because theoretically, long term, you should be taking more risk because your money's out or being invested for a longer time frame. That being said, the market inverted late last year, but has since uninverted, which people believe says that the market's actually correcting and that it was just a false positive. That being said, the yield curve has a pretty strong track record where it basically has preceded almost every recession that we've had. And so that's one of the clearest signs that we might be on the verge of a recession. On top of that, other indicators have come out, such as RV sales actually have a pretty strong track record of predicting recessions. And RV sales came out and said that RV sales have dropped significantly year over year, and that usually, again, precedes a recession. Others are fear and greed index. So to put in perspective, a famed investor, John Templeton, put it this way: bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So basically what that translates to is, people get scared, kind of as I was mentioning, how behavioral finance really controls the market, just because we get a lot of emotions that ultimately, have an impact on our stock market behavior. Well, when people are fearful, the stock market tends to drop. But that's when you start to see people slowly buy back in, and because ultimately you'll have the person that's the least scared will buy back in. Well, as the stock market grows and grows and grows, people keep adding in money, ultimately until where there's no money left that can be solvent to add on to the top of the market. And that's where you see, and that's where that greed kind of kicks in, because people see the stock market keep going up and they just keep buying higher and higher and higher, and that drives it higher. I mean, I'm sure you've seen this with any bubble. Like one of the biggest one recently was Bitcoin, where it went up and up and up and up to the point where it was like $18,000 and no one could afford it anymore to buy one coin. So you saw it immediately crash. So that's kind of what happens with different bull market cycles, more often on like a slow, prolonged scale, but not as kind of dramatically as Bitcoin did. But it's the same concept. And right now, over the past couple months, there's like an index that actually determines whether the consumers are being greedy or are they being fearful in terms of how they're acting. And over the past couple months, it's actually shown that they've been pretty greedy, even as high as like super greedy. So that's an indication that, again, we're at the top of that market. We're at the point where we're getting near that euphoria. So again, not a great indicator on the positive impact of the market going into 2020. So all in all, what does this mean for 2020? Obviously, we have no way of accurately predicting a recession. Anyone that tells you they can accurately predict a recession, run away from that person scared, because they are wrong, and don't ever touch your money near them. But there's really no way to accurately predict when a recession is gonna hit. But that being said, there are a lot of risks in the market right now, and I would say there's definitely more downside risk, so risk of a recession coming, than there are of the market continuing to go on for this sustainable future. So if I were to guess, I would say that there probably will be a recession sometime in 2020. When that's going to happen, who knows? But if I were to bet, that would be probably where I'd bet. I mean, I don't know if it's going to be as accurate as Ray Dalio betting on March 31st, but that being said, I would not be surprised if there is a recession sometime in the next year. Again, there's no guarantee of that, and I wouldn't necessarily say it's 100% probability. I would say it's just probably better odds than not. So maybe 60% chance that there's going to be a recession. So that being said, some of the things you can do are start preparing your portfolio just in case. And the easiest way to do that is just don't take a lot of risk in your portfolio if there's no upside to gain for that risk. So start maybe taking more conservative plays or going into cash. So that way you can be prepared for when there is a recession. You have money to then reallocate when stocks go on sale. Hopefully you found this video valuable. If you did, give it a like, and what do you think the probability of recession is? I'd love to hear from you. So link down in the comments and give me your best guess on what the probability of a recession is. Love to hear it. Otherwise, tune in to the next time for our next videos, and make sure you subscribe to this channel, click that little bell, and so that way you get notified of any future videos. Cheers.